Hello, everyone, and welcome to today's Blockworks webinar, Beyond Vanilla, What Comes Next for Quantitative Crypto Indices. During the webinar, please submit your questions to our speakers through the Q&A function at the bottom of your screen. We will save some time at the end of the discussion to answer these. This session will be available on demand, and all registrants will receive an email once the recording is live. Today's webinar is sponsored by Kaiko. The views of myself as the moderator and the panelists are not associated with the organizations that they represent, nor should anything on today's webinar be construed or taken as financial, investment, tax, or legal advice. My name is Bennett Holloway, and I'm the Content Director for Institutional Events here at Blockworks. And we're joined by three excellent panelists today, so I'd like to invite them onto the screen now. We have David Lavalle of Grayscale, Leah Wald of Valkyrie Investments, and William Kai of Kaiko. So, folks, if you could give some intros.
Great. Well, Bennett, thanks so much for having us here. It's super exciting to be participating in the event. As you mentioned, my name is Dave Lavalle. I am the global head of ETFs here at Grayscale. Grayscale is the largest crypto asset manager in the world. We're really proud about that. Obviously, our flagship product, GBTC, is what most people know us about. And, Bennett asked kind of my path to crypto. Well, I've really been in traditional finance up until joining Grayscale about 2.5 years ago. And most recently, preceding my time at Grayscale, was a CEO of a global indexing firm. So bringing some indexing perspective to the conversation here. But I've largely lived my life in traditional finance, in and around exchanges, financial products, working at asset managers and an exchange, and then also running a broker-dealer on the floors of the American and New York Stock Exchange. So happy to wear any one of those hats to add to the conversation today, and very pleased to be here. So thank you very much.
So I'll go next again. And Bennett, thank you so much for having me. David, William, this is going to be a lot of fun today. So it's great to be on a panel with all of you. So my name is Leah Wald. I'm the co-founder CEO of Valkyrie Investments. Valkyrie also launched a series of ETFs. We actually sold our ETF business last month to CoinShares. Backing it up a little bit on how I got into the space. Actually, I started my career at the World Bank. It was at the World Bank that I saw a program called M-Pesa that was launched, which was the first SMS-based microfinance system in 2009. So when I learned about Bitcoin, its principles made complete sense to me. I'm a technologist and deep dive, straight in. After that, I started a technology company called Veterati that connects unemployed veterans to mentors in service of job placement. So obviously, I'm obsessed with tech. Kept learning about Bitcoin and started in Bitcoin asset management full-time around 2016 with Lucid. And then I teamed up with my co-founder, Stephen McClurg, who hails from Guggenheim Partners, and we launched Valkyrie. And since then, we've been off to the races with cryptocurrency grantor trusts, similar to Grayscales, but in private format, hedge funds, SMAs, and then, of course, the ETF business.
Hi, everyone. My name is Will. My background is also in TradFi. I spent 20 years in New York City, mostly with JP Morgan. I traded exotic derivatives in equities and credit. In the second half of my career, I traded commodity futures. Our desk was not sector specific, but we built overall commodity strategies ranging from beta, smart beta to pure alpha strategies for large institutional clients. I'm currently the head of Kaiko Indices. Kaiko at heart is we're a data company. We cover over 100 exchanges, over 100 exchanges, over 400 tokens. So with our vertical data integration, we have the perfect platform to build crypto benchmarks and indices. So we build indices for use in ETFs and funds, for exchange derivative settlements, and generally for any crypto financial product.
Thanks, everyone. Well, today we want to look forward and explore the evolving frontier of structured products and kind of look under the hood of the indices that these products are linked to and see how they'll drive innovation in crypto markets. So whether you're new to the space and just encountering these ideas, or a longtime index junkie like our panelists here, thank you for joining us today. And want to first, just by start by defining index. It's a term with a very broad aperture. So, William, could you just kind of set the stage for this conversation and orient us towards the idea of indexes?
Yeah, sure. I'll go first. I think index can cover a wide range of different things, but to me, indices are designed to represent and measure performance of various assets or a basket asset or specific investment strategies. And I think it's good to make the distinction between an investable index. So you can make an index on pretty much anything. For example, the number of people in the world, right? You can calculate it, you can track it. It could be a good indicator of something, but you cannot invest in it. You can't trade it. So it's important for us when we design benchmarks or indices, they should be investable or tradable, which I think is quite relevant in crypto, given the fragmented markets, the different pools of liquidity, and maybe another example, right? A simple one. If I make an index of two assets, Bitcoin, and let's say the 200th asset by market cap, 50-50, and we balance it quarterly. But is that really an investable strategy or index? Maybe, maybe not, given the liquidity. If I wanted to only trade $1 million of it, maybe it's okay. But if I want to do size, that 200th asset by market cap, potentially liquidity isn't there. So these are some of the considerations that we think about, especially here doing indices in crypto.
That's great. Dave, with a pretty extensive TradFi background in those various roles that you mentioned, would you add anything to that, particularly on the note of the investable versus non-investable indices in traditional capital markets?
Yeah, so one of the things that I would, kind of always point to is oftentimes people, use indexing and passive investing synonymously, and I think it's pretty short-sighted. There's also been kind of a long, we're 30 years into ETFs right now, and not to say that there weren't mutual funds that were passive mutual funds, but largely the kind of advancement, the growth, and the excitement around ETF investing was really largely index driven. And so the proliferation of kind of going from a handful of ETFs in the 90s to thousands of ETFs now around the globe, there's a tremendous amount of proliferation from product exposure ideas. But I think people also fail to recognize that there was a tremendous evolution in indexing more generally. And so we think about S&P 500 market cap weighted index as kind of your benchmark kind of equity index. But over time, the indexing strategies really became more and more sophisticated. Market cap weighting was something that was certainly continued to be used, but equal weights or factor weighting or multi-factor weighting. And so we've seen a real evolution, not only with kind of product proliferation and product wrapper proliferation, but also with the index strategy. So I would just also kind of layer in that on top of everything that Will had to say, that indexing or index-based investing is not necessarily synonymous with passive investing.
That's great. Thanks. Leah, anything to add there?
No, I think they covered it.
Okay, Leah, to you. So we've kind of covered the sophistication and the spectrum of indices in traditional markets. One thing over the last 6 months that's constantly been in the headlines in the crypto space is, of course, the spot Bitcoin ETF. If we view that as sort of on the less sophisticated end of an index-linked product, could you kind of give us a sense of what else is out there in the realm of structured products within the crypto space?
Yeah, I think it's a good question. I think that it's probably important to harp and stick on the different spot products first, and then let's go into what's a little more sophisticated, because based on the regulatory regime globally, you see certain nuances between the different products, whether it's an ETP or an ETF, or how they're actually structured. So just to note, there are quite a few spot products globally. You'll find spot ETFs in Germany, Brazil, Australia, Liechtenstein, Guernsey, many others. To back it up, the Swiss 6 was always the most regulatory forward on listing spot products, and you can find the top 10 from Solana, Ether, Litecoin, DOT, as well as index funds. You're also now seeing a push in Asia for the ETFs as well, with Hong Kong's regulators having approved the Bitcoin spot and Ether ETFs just 1 week ago. So going on, there's other options, of course. There are thematics, there are the futures, where we've seen this type of demand waiting on the sideline for these Bitcoin spot ETFs. There's leverage, there's inverse, there's also still interested participants in the Bitcoin futures ETFs, since we've seen that with BITO's inflows. And again, the thematic ETFs, such as Bitcoin miners like WAGMI, many investors see that as a picks and shovels sort of investment strategy. So as we know, GLD gave the public access to the gold markets, and crypto spot is making it easier for the public who are mandated or prefer to have that regulated product. So what you're seeing, in my opinion, is a bifurcation of two marketplaces, the listed and the unlisted, with TradFi issuers creating public funds, whether they're structured or ETFs, into these vehicle solutions for institutional pent-up demand that we believe will go token by token, jurisdiction by jurisdiction, get sophisticated as much as they need be based on the demand that they're seeing.
Yeah, that's great. So, William, shifting kind of away from the high-level structured products.
Add a little bit to that, actually. In terms of, I know the topic, the title of our webinar has vanilla in there, right? Vanilla indices, where we go from here. Excuse me. But as Leah and Dave know, even in the spot Bitcoin ETFs, track a benchmark. I think, but most people don't realize how much goes into that benchmark. I mean, we as benchmark makers is spend a lot of brain cells on coming up the right strategy. Well, first you got to have the connectivity to all the exchanges. Bitcoin isn't like a stock; it doesn't just trade on a single exchange. All the exchanges, you got to do exchange vetting. We got to have all the infrastructure for data connectivity. Make sure the data is fine, and then how do you calculate that one price? It's not just a snapshot at a fixing time. We usually different benchmark providers do things a little differently. Usually over an hour or a period of time. You have, is it average? Is it a median? So there's a ton of stuff that in the background goes into calculating a single Bitcoin price, and it's not just valuation, as our friends here know. SEC forced everyone to do cash creation redemptions. So there's trading implications, market maker, making markets, they need to hit that benchmark. So all those things are baked into something that 99% of people don't see. They just, it's Bitcoin, fine. So I just want to say that even today's vanilla is actually not quite vanilla, but it is the building blocks that we see that we can build. The sky's the limit in terms of indices that we can do. So I'm excited for the future.
So you're saying these products are a far cry from just simple rocks in a box, as the gold ETF is maybe referred to as. Well, let's go down that rabbit hole. Could you maybe kind of further extrapolate some of the intricacies of things that go into calculating the price of an index? And Dave, feel free to jump in here, but what are some of the most pertinent sort of intricacies in the mechanics of indices?
Yeah, maybe I'll go first. I mean, to what Dave had alluded before, I was just thinking about it today, right? Almost indices are, in a way, TradFi's smart contract, in the sense that you build this methodology in there, and that's it. And then it goes and does work. It could do a lot of different things, but it doesn't change. So as a thought, I would love to see a tokenized index develop. Later on, perhaps we can talk about it. It'd be really cool. But coming back, even in the benchmark, Bitcoin benchmark rate, as I was mentioning, it is a set methodology in terms of exchange vetting, the connectivity of the data, and also the specific methodology. A lot of it is you do need to have the expertise. So us, like many others, we're regulated under BMR, the benchmark regulation in the EU benchmark regulation framework. So we do things very, very robustly and carefully, and which is great, not just for ETFs but other uses where a trusted party is very necessary in this space, that we provide this robust calculation and deliver it to our clients in a very robust and efficient way.
Yeah, I would, Bennett, and I would layer into what Will, has outlined here. Maybe just take a step back and explain how just a plain old, equity-based index is calculated. It's quite simple. I think it's pretty much well established that if you have a security in equity that's in your index, you take the closing price, the 4 p.m. closing price of the primary listing venue's exchange. So if it's NYSE listed, you take a look at the 4 p.m. price on the NYSE. If it's if it's NASDAQ listed, you take a look at the 4 p.m. closing price on NASDAQ. You kind of snap those all together and you have a benchmark. It's just not that simple when you're talking about an asset that is trading 24 hours a day, and is not trading inside of an exchange framework that's simply regulated by the SEC. And so, look, that comes with additional layers of complexity. It also comes with a tremendous amount of transparency. And that's to the benefit of the end investor. Now, I always say, not every ETF is created equally, and not every ETF issuer is created equally, and frankly, not every index is created equally. And so it's really incumbent upon the user to ensure they understand precisely how the methodology works. And essentially, they all do the same thing. They just do it in a little bit of a different fashion. And what that results in is a little bit of variance as to what the kind of, index price is for that particular day. You start off with a universe of exchanges. That universe of exchanges is vetted to, get down to some sort of selection of that, or some sort of, subset of that, universe of exchanges. And then there's some sort of methodology that kind of blends or takes into account all those different prices, typically in some sort of, time window and snapshot of a time window, with some sort of methodology that blends those all together to kind of have effectively some index benchmark rate for the particular day. And so you might see variance between different, indexes that are, bringing a spot Bitcoin price to market or another spot exposure to market. But ultimately they're doing the same thing, which is to deliver a value for that underlying asset that, represents a daily snapshot for purposes of striking the underlying product's net asset value.
And if I could add to that, oh, sorry, go for it, Bennett.
No, Leah, please you.
And as we know, crypto is complicated. There's still hacks. There is staking daisy chains. There is all these myriad issues and nuances that we love. However, that does create those complications on needing to have such powerful indices that do take into account what's happening. There's wallet movements that sometimes need to be negated. There's OFAC compliant pools that need to be analyzed and decided upon. There's decisions that go into this. So companies like Kaiko, it's not set and forget it with APIs by no means. It really does take also a lot of analysis from those in the space from a fundamental perspective on understanding what's happening on chain. Take ETH as just a very quick example. We know the new staking protocol is a little bit difficult, and 3% of what's staked is actually restaked in liquid staking protocols. So you have just this, and that's ETH. Start going down the list, and there's a lot of tokens listed around the world that are much more esoteric and thinly traded, and on exchanges that are hard to access good data from, whether they may be in Asia, whether there's regulatory shifts. We've seen in Korea the rise of Upbit, and also just changes on those exchanges. So just behind the hood, even getting that data, analyzing that data, what wallets need to change, and also now just very quickly debates around the fungibility or not of Bitcoin given ordinals and rare sats and everything that's happening applies an even greater complexity to Bitcoin when we thought that potentially Bitcoin was the easy one to analyze. So definitely a lot under the hood to even just take that snapshot for sure.
Yeah, of course. So kind of wanting to delve into the flavors of indices within the crypto space that are beyond vanilla, as our title suggests. Maybe one question to kick off this element of the discussion is, what are the on-chain versus off-chain implications of these products, both in terms of the issuer or the sponsor, as well as how the user interacts with them, to any extent that there are major on-chain versus off-chain implications.
So sure, I'll go first. So currently for us, most of our current data and indices are based off off-chain transactions. So we take data from centralized exchanges. We do take some liquidity data and trading data from DeFi, but currently those are difficult to incorporate into the current benchmarks. Not quite there yet. I mean, we collectively spend so much time and money just to get spot Bitcoin through. Some of it is just, I think there was so much focus on that, right? I think in Jan, everyone was like, oh, sigh of relief. Now what? We got now we got to do more interesting stuff. So this is kind of where we, even though it's April, I think this is where we are. For us, Kaiko, we get the data. For indices, we're thinking about how to incorporate some of the off-chain data into our indices. That's that our clients, whether it's investors or exchanges, starting to look at and see where we go from there.
That's great. So earlier, there's been terms that have come up like active and passive management. Could you all draw some distinctions in how those who are formulating the indices or managing a structured product linked to an indice potentially employ different strategies to construct that or manage it if it's correlated to price?
Maybe I can jump in first. I think Dave definitely alluded to that. The complexity of indices. There are passive funds and active, to me, actively managed, active funds, which are actively managed. There's discretion and there's passive funds. But within passive funds, they can track strategies, indices that's highly complex. The methodology that's built in there, it could also handle various different assets and not just spot assets, stocks or crypto, but options. You can build an option trading strategy. You can have volatility components. So to me, it's still passive, but these are systematic and non-discretionary trading strategies that can be as complex as you want, but consideration still needs to be given to making sure they're tradable. To my prior point, you can't just bake everything in there and say, hey, here's something cool. But no, you got to make sure that you can replicate, you can trade this instrument through the different market assets, that's whether it's crypto or other asset classes.
Yeah, I would layer in that sometimes when you think about an active strategy, one of the first things that comes to mind is the frequency with which, the strategy is kind of rebalanced or trades. And, you can have an index-based strategy that has, a monthly rebalance. And it has to obviously have an index methodology that's pretty prescriptive as to what the methodology is and what the, target outcome is. But there are plenty of strategies out there that are index-based that are showing quite a bit of frequency in terms of the rebalancing construct, reconstitution construct, and therefore it has a much more kind of active feel to it, despite the fact that it is, methodology-based, non-discretionary, and index-based and passive in that sense. So I constantly, think about the evolution of indexing in kind of traditional finance. And I think a lot of that, evolution of the index methodologies becoming more and more complex was really driven in some ways as kind of a regulatory arb, so to speak. And the exchanges had, many generic listing rules for index-based strategies. But if you wanted to bring an active strategy to market, there was a much more prolonged regulatory engagement process with the SEC's Division of Trading and Markets. And therefore, what ended up happening is, individual firms were looking for ways to embed a more active strategy into an index methodology, which is precisely what transpired. As we look forward in, the kind of crypto landscape of products that are coming to market, the concept of multi-token indexes is not new. I mean, we have products that are currently in market, and so I wouldn't say that it would be a new concept. However, aside from market cap weighting, we really haven't seen a tremendous amount of evolution or a tremendous amount of kind of innovation. So concepts around factor investing like momentum, or factor investing like growth, or factor investing like quality, or maybe there are other crypto specific factors that will be developed that will be made available to investors. Now the reality is product development teams love to come up with really creative, innovative solutions that are exciting for them. It has to be an appropriate kind of demand profile from the end investor. And the truth is, when we look at the spectrum of where investors are on their crypto journey, it's a pretty broad spectrum. The one extreme is that crypto is going to change the way we do everything in the next 18 months, and then the other extreme is that Bitcoin is really just for illicit activities and terrorism. So like there's a big long spectrum in between there, and you have to figure out how you're going to develop products, what indexes you're going to build, and how that's going to meet the demand profile of investors. Currently, we've gotten this opportunity to have a Bitcoin ETF in market. It's super exciting. We're about 3.5 months into it. The process of onboarding at wirehouses and getting these into the hands of the wealth management professionals or financial professionals that are really in control of 30 trillion in assets in the US market hasn't even really happened yet. So I think despite the excitement and the exuberance that we all have as product creators and indexers and asset managers, there's going to be a process here, and we need to make sure that we're bringing products to market that meet clients where they are on their crypto journey.
And if I could add to that and tie in your previous question of on and off chain metrics, and Dave, I appreciate that a lot. There's also liquidity constraints. There's a lot of other constraints that are specific to what we can and can't do per SEC guidance for onshore liquidity that needs to be taken into consideration. It is hard to track many of the off-chain transactions. For a long time, what was known as the fundamental analysis in the space was truly just following miner flows, and then it got more sophisticated. However, if you start looking down some of the developments, whether it's Liquid or Lightning Network, I actually think that there's going to be a concern in the future if these are even seen as mixers, and therefore it's actually more difficult to follow some of the off-chain and on-chain movements, but it is not as transparent as saying, okay, this is on-chain and Bitcoin is only pseudonymous, so we can actually follow it. That's not the case right now. And again, especially as liquidity gets tighter and you have to look to global exchanges specific to multi-coin strategies that are actively managed, where maybe some of the tokens are not as liquid here in the United States. So just a note that to William and Dave's point, that when it comes to on and off-chain strategies, there's also a potential liquidity concern and issue, and ensuring that the coins that you're actually getting are onshore and applicable and compliant.
I'll add one more thing, Bennett, as we're thinking about it, and it really triggered as Leah was speaking. Even if you do have a traditional, truly an active strategy, that probably isn't, close to seeking kind of a, kind of an ETF, kind of approval, because we're, a little bit slow on that process, which we can understand. The truth is you still need a benchmark. And so as the space grows and you have more and more managers bringing more and more complex products to market, and those products are going to be brought to market, and maybe it's a GPLP strategy, maybe it's a hedge fund strategy, maybe it's a private fund strategy, whatever it might be, we're going to need to have benchmarks that are going to help us as investors track the performance of the underlying strategy. And so I think there's still a tremendous amount of development to be had there, so that we can ensure that, we do have benchmarks in market, whether or not they're actually tracking, a particular, product with a particular performance metric, but it could just be utilized as actually a benchmark for other active managers, and to track and compare performance across multiple strategies and multiple asset managers.
What is that sort of consensus benchmark right now, and would you propose a different one?
I mean, I'm a bit biased, but obviously we have our, Grayscale's GDLC is a large cap, benchmark that we utilize and we point to. But listen, we're early stages of, having the opportunity for, investors to really be able to access a broad range of investment themes or investment strategies. And, the suite of, crypto-based asset managers is only going to grow. The number of portfolio managers that are going to be bringing products to market and asset managers that are going to be bringing, multi-token or kind of diversified products to market is going to increase. And there's going to need to be an opportunity to benchmark those products against one another so that you can have a good sense of how it's performing, relative to kind of a common benchmark.
Yeah, we're definitely here at Kaiko, especially Kaiko Indices, we try to make sure we're ready because things in crypto sometimes, it doesn't happen for a long time, and then suddenly everything's moving. I mean, ETF might be not the best example because SEC had made that situation unique. But even so, as Dave has and Leah alluded to, the ETF, at least in the US, potential development a bit slow. SEC, whether it's ETH or ETF or even options on ETFs, but we see asset managers are thinking about other vehicles. Look, again, Bitcoin ETF out of the way. Is it private funds? Is it SMAs? Whichever vehicle that, to what Dave said, likely you need a benchmark, you need an index strategy that's crafted carefully and has the benefit of being transparent. Its methodology, its calculation, its data sources. Is it trusted? Are you doing a good job of vetting exchanges and so forth? So we're making sure our infrastructure and our data collection are robust and scalable, whether it's in spot or derivatives. I think there's interest in calls and puts in terms of volatility product. And we're always forward looking and trying to be partners to our clients, whether it's exchanges or funds, not to just create the benchmark for today, but for the future products that our clients have and the vision and the roadmap that they have. We would like to be partners and help them to do that.
Yeah, and if I could add, oh, sorry, go for it, Bennett.
Oh no, please follow on.
I could add to it. It was very interesting. I'm sure the three of us or four of us remember in 2021, it was just so hot to ask for a multi-coin strategy. We prided ourselves at Valkyrie for running actively managed native token funds, whether they were SMAs or we've had 2 hedge funds as well. And that's exactly right. Everyone, all the advisors, everybody that was being pushed didn't want their clients didn't want Bitcoin, ETH, they wanted everything. And that was, very much being asked for, but there was no appropriate and competitively priced benchmarks at the time. So I remember we benchmarked against Bitcoin and ETH because, that was the easiest for us to do internally. But obviously that, thanks to Kaiko and other providers, that's become easier. But I absolutely remember that time in 2021 where that was what was being asked for, but it, really wasn't, solid benchmarks there to provide and bench against performance for our clients. It's changed, thankfully.
Yeah,
Exactly.
Bennett, one more thing that I would say, I know you have some other questions, but I'm going to layer in here. It's back to this like kind of, the Bitcoin ETF being the first of many steps. And I think there is a point of credibility and a point of validation for the asset class that has happened as a result of the Bitcoin ETF coming to market. And I'll expand on that a little bit. The point that I think is really important is that historically, in the kind of 15 plus years that I've seen innovations in ETFs, there's long been a focus on the underlying asset and kind of the ability for the underlying asset to be, liquid enough and track appropriately and have the appropriate data. And then there was always a constant conversation around whether the ETF product was going to behave as designed. Is the creation redemption process going to work effectively? When we got to this conversation over the past 10 years, of a Bitcoin ETF, a spot Bitcoin ETF coming to market, it was really just about the underlying asset. The ETF wrapper has kind of been a proven, battle-tested wrapper. And so the fact that there is now spot Bitcoin available in an ETF wrapper is a massive point of credibility for the entirety of the wealth management, platforms and market and, advised market, so to speak. And, additionally, what needed to transpire and the firms that have shown up to make this work are some of the largest financial institutions in the world, on the administration side and the custody side, and certainly some very large asset managers are giving more credibility, more credence, and more validity to the asset class holistically. And it's opening the eyes to, a very broad range of investors, some of the smallest retail investors to some of the largest institutions in the world that now are going to be focused on, okay, like what's next? We've got Bitcoin, we might understand ETH, but what's next? And the what's next is going to be taking into account some really tried and true, investment strategies that have been beneficial for other asset classes. And the first that comes to mind is diversifying your exposure and really participating along the entirety of the cap spectrum. And so I think we're just in the beginning stages of people focusing on this brand new asset class. They know that it's valid. They can't ignore it any longer. If they had buried their head in the sand because they, weren't able to bring it to their clients because it wasn't available on their platform, that is going to be, gone in the very near future. And they're going to have to do the homework to have an opinion on it. And what's going to happen after that is diversified exposure, participating along the cap spectrum, and things are going to get really interesting for, Leah, Will, and myself.
One last thing, and Dave, you'll remember this day. Our head of fund ops launched currency shares ETF, if you remember.
Yep.
So everything of what you're talking about, it was, the service employee providers coming to the table, developing with that team. But also the rest of the plumbing came a little bit later, and it was to develop with that team as per what was needed. So I agree with what you're saying, and Kaiko is an example, but the whole industry will develop together as the needs present itself, as well as it did with currency shares.
Super interesting, especially the distinctions between underlying assets and then wrappers, and kind of how that conversation has unfolded. I have a question that came from one of our research analysts here at the Blockworks team. He posed it as, let's say you were talking to a large family office or someone who's doing their homework, exploring the crypto space, and they're choosing between allocating to a venture fund versus one of these sort of quantitative, actively managed indices. How would you sort of guide that allocator through that conversation, depending upon their kind of expectations of return or risk or wrapper? What would the considerations be there?
I can start. It's kind of like, this is a crude analogy, but my son wants dessert. Do you want cake or do you want ice cream? They're two very, very different things. And so I don't want to dismiss your research team members' question, but I think it's ultimately starts with suitability. It starts with, other considerations around liquidity. And it really is about kind of time horizon of your investment and what the strategies are ultimately going to be. I mean, even if we went the venture route and talked about that, or we went the quantitative, kind of index route, those can be so many different strategies that could be delivered in each one of those wrappers. So I think the question is too broad. But there are certainly, fundamental considerations around liquidity, time horizon of investment, and those type of things that really need to be outlined before, I could really effectively answer that question. Well, one thing that I will say is, if you have an index-based strategy, no matter how quantitative it is, the level of transparency is going to be, significantly higher, I would suppose, than if you were going to go into something that's a much less liquid, less transparent kind of, venture fund construct. And so, there's a tremendous amount of kind of research and diligence that's required before you're going to make an investment decision like that. But I would say the values and the merits of an index-based strategy lend itself to, obviously the level of transparency that you have into the methodology that's going to be, driving the investment. And then you can have a better understanding of modeling, the potential returns. Those are kind of some of the merits of kind of, index-based investing, no matter how quantitative the strategy is, relative to something that has less liquidity and less transparency.
Yeah, I mean, in traditional space, if I was an indexer and someone comes and say, "Hey, can you build an index for venture funds or venture endeavors?" I'd be like, "Ah, I gotta really think." But maybe in crypto, I'm just thinking out loud. It could be, I say Kaiko. It could be a little more interesting because a lot of these tokens are almost, venture-like. They represent the companies or platforms they're in its early days. So maybe I'm just thinking out loud, we could build and backtest a strategy of tokens that could be similar in performance to a actual venture fund, at least in terms of there's not too much historicals to go on. But that's something that's possible. We always like to. Sometimes clients come to us with very exotic requests. We like to work with them and to see how we can capture that idea and build it into an index that could potentially be achieve our clients' objectives.
I'm going to take this on a very high level, 50,000 feet level. I think also the question is just how do you speak to interested allocators and explain what they're interested in, as well as what should the pitch be? Let's say if you're an issuer and you do want that client, maybe you have both a VC and an ETF. And I think what's interesting and exciting for me is that whereas trading strategies have vastly changed with these different offerings, investment opportunity strategies have very changed as well. So Dave mentioned, what's your time horizon? What's your trading strategy? What's your investment strategy? That is, of course, the most important thing to think of, especially when it comes to using your example of VC, right? But what again is interesting to me is with these different vehicles, these different options, you can make a sophisticated risk managed strategy that can hedge, that can again use these different vehicles in a way that's appropriate to what your firm needs. For a lot of the sovereigns, pensions, insurance that we're going to see coming in long only with a small allocation. We've seen, very recently that from the 13F filings that other RIAs are starting to buy Fidelity and the other large issuers with even a large 3 to 5% allocation. So when folks at these firms are speaking to these potential and interested allocators, you actually can present all these options. And from their investment committees and their CIO, they can make a very informed decision. And I would say that didn't exist until very recently, when you had just a small amount of products and you had to be very sophisticated and actively trading, which isn't every single shop. Definitely not these RIAs, which have bosses on bosses on bosses for investment committees. So I think that it's actually a real development and evolution of the industry to even be able to start speaking to those RIAs and helping them make those investment decisions.
Yeah, excellent point. We got one more question before we get to our audience Q&A, which we have a couple lined up for. So reminder to the audience, use the Q&A function at the bottom of your Zoom webinar screen, and let's put some more good questions in front of the panelists. But sort of last thing before we get there, we've talked about the need for a benchmark for performance in the crypto space. What other needs are there in the crypto space in terms of non-structured products indices? So maybe a comparable CPI index in the crypto space or VIX in the crypto space. So anything along those lines?
Yeah, maybe I'll go first. I mean, one area we haven't touched on, at least in the current webinar call, is use in benchmark or index used in exchange products, exchange traded products. Well, not an ETF, I know that is also an exchange traded product, but more so on futures and perps. Especially what we see in the global exchanges in terms of their perpetual futures or calendar futures, there is an evolution towards using third-party transparent benchmark to settle their futures versus using their own prices. I think given the regulatory evolution, whether it's in US, EMEA, or in Asia, and investor trader demand, all exchanges are moving towards more transparency. So we're helping a lot of exchanges to develop benchmarks that's similar to a benchmark used in an ETF, but then there's some different distinctions in terms of, for example, for perps, the 24/7 support and reliability is key because their product rely on our benchmark 24/7 versus just potentially a fixing once a day fixing. So that area of development has been very interesting, and we potentially will see perps or futures on baskets or a VIX-like product that potentially will come out. So we're actively working on these areas and for those clients.
Yeah, that was a super thoughtful answer, Will. I would also just say maybe a little bit more simply, it's some things that we've seen in TradFi around risk managed strategies, volatility, target vol strategies. We haven't even scratched the surface on options based strategies, and there's a host of, we've seen some covered call strategies, but we haven't even scratched the surface on some of the target outcome, buffered outcome strategies that are employing some more sophisticated utilization of flex options and some other cool things that I think are just a matter of time that these are going to be coming to market. But again, we're early innings.
Great, excellent. So let's get to a couple of our audience questions. First, we've got an attendee who asked, when do APs or authorized participants purchase the underlying BTC for the spot ETFs, given it's such a volatile asset? So kind of that active management of the vanilla category of ETFs. Anyone want to take a stab at that?
Sure. It's actually much simpler than one might imagine, and it's really apropos that the question is being asked in an indexing kind of webinar. The point is authorized participants are interested in creating and redeeming these ETFs, but it's really critical for them to ensure that they're creating and redeeming the ETF and hitting the actual benchmark strike, so that NAV of the ETF on that particular day. And so authorized participants are paying a tremendous amount of attention to ensuring that they are able to target that NAV strike or that benchmark for a particular day. Now, this is a little bit of an oversimplification, given that these are all cash create redeem. But if in fact this was kind of an in-kind construct, they would be ensuring that they're delivering that Bitcoin struck to the NAV or struck to the index strike for that particular day. In reality, given that these are cash create redeems, the AP is really just sending in cash in exchange for shares, and the sponsors or the different registrants or the different issuers are ensuring that that cash is turned into Bitcoin and the Bitcoin is being sent to the trust. So really the nuance to answering the question here is that those liquidity providers that are employed or kind of hired by the asset managers are really focused on ensuring that they're hitting that NAV strike or hitting that index benchmark. So it's a little bit of a complex answer, but I think I'm getting to the point of the question from the listener.
Yeah, that's great. Follow up to that, is there a foreseeable future where these products are in-kind redemption rather than the cash create redeem?
It's a hard question to answer. I quit my side job of predicting the behavior of how the regulators are going to kind of permit or not permit certain behaviors within the ETF in the ETF construct. Obviously, the SEC approved all of these products and had a very strict mandate that these were going to be cash create redeem only. And that was really with a heavy focus on some of the permissions or prohibitions of what broker-dealers in the U.S. market are permitted to do as it pertains to, touching digital assets. And so, I wouldn't say this is like a never construct, but I think there's, going to have to be some more regulatory clarity around, permissions of broker-dealers to deal in digital assets before we'll see, an in-kind create redeem construct for spot crypto ETFs.
Yeah, the SEC, they got to keep us on our toes. It's I think, Dave, I saw a smile when you mentioned division trading and markets early on. I mean, yeah, we'll see. We have to live with the regulators, but I think, look, it's crypto. I'm always optimistic. I think, hopefully, to me as a trader, it's in kind is a no-brainer, and the tax benefits potential to investors. So yeah, I'm hopeful that this will happen.
Excellent. So next question is, what advantages might a tokenized investable index enable over a traditional off-chain wrapper? So I think this is sort of getting at along the lines of, we're seeing large institutions like BlackRock roll out money market fund on chain with their BUIDL fund. I think that was announced probably 2 weeks ago. So is there any proprietary advantage for these index linked products to be tokenized?
I'll go first. To me, the tokenized world, we're just in the beginning, very beginning. We'll see, it's unclear how it's going to evolve. But in a tokenized index, and we'll see how the specifics will evolve as we develop. But ideally, for currently, as I mentioned before, an index has its rules, right? Its methodology is static. It can do a lot of different things, but one thing it cannot do is trade. The current index cannot do something by itself and trade. But if it's within the smart contract, married with smart contracts, fully tokenized, and they're now pools of liquidity, they are fully decentralized. So it's potential that a tokenized investable index could actually trade, rebalance, and do all kinds of things without ever touching a person, a real market maker or person, a human market maker. Everything is transparent and it's decentralized. So, but there are probably going to be trade-offs, just as decentralized exchanges. There are often potential liquidity trade-offs or speed or in terms of slippage potentially. But we'll see. We'll see how it develops, how the DeFi space overall will evolve. Things will improve, and I'm very excited for a fully tokenized and decentralized index.
I would also say it's, with all the merits and potential benefits of tokenizing real world assets, I think the biggest inhibitor is that there has to be the ability to actually, utilize them and access them. And so the distance right now between, traditional finance platforms and the ability for tokenized assets to be incorporated into them is pretty wide right now. And I'll just take one example. It's the simplest example that we have had conversations with many service providers that are, really, well ingrained in traditional finance, going from, 2, 3, or 4 decimal places to 8 decimal places to be able to handle, Bitcoin is something that is a massive lift for, large organizations in many instances. Now, everyone showed up and they figured it out and they did it and have been able to support these Bitcoin ETFs, but there are, non-trivial technical challenges that are required to be overcome to even have the simplest of traditional finance wrappers like an ETF to be incorporated into clients' portfolios. And so when we start talking about, tokenizing real world assets and then, incorporating them into clients' portfolios, I think there's a tremendous amount of work that needs to be done. And the timeline around that is a little bit uncertain to me.
You don't talk to them about billions of sats? That's not.
Yeah, exactly.
I would agree with both of you guys. Just on quick notes on a technical side, there's still so much on the technical side that hasn't been figured out from an investable perspective, whether it's a appropriate and indexed again, redeemable wallet. Most of the tokens it's still confusing on, there's a lot that still needs to be figured out. I'll just end it there for sure.
Yeah, I hope we see the world where we denominate things in sats sooner rather than later. That would be great. Well, we've just got 5 minutes left. Guys, thank you so much for joining us today for this conversation. Final question For the attendees, where can everyone best follow your work? Do you have any socials, and how can they stay plugged in with the organizational efforts you've got going?
Sure. For us, always come to our website, www.kaiko.com. Also, we also post a lot of we have free research and publications through our LinkedIn. You can find us on LinkedIn as well.
For Valkyrie, again, we recently sold the ETF business to CoinShares. We do have a couple private funds. So you could go to our Twitter account or LinkedIn, and always happy to help if, anyone has questions.
Guess I'll go last. Grayscale.com is a tremendous wealth of information. I'm super proud of our research team and the research that they publish. You can certainly, sign up for our newsletter there. And then obviously you can follow us on X, and you can also, follow us on LinkedIn. I think we do a pretty good job of, populating those handles with really good information for investors.
Thanks again for joining this conversation. Again, whether you're new to the space or you've been around the indices world for a while, I think there was a lot to gain from the insights from our panelists. One reminder is that this conversation will be available on playback on the Blockworks website where you registered using the link. And so feel free to send that to your colleagues and, continue to spread the word. And again, to our panelists, thank you for taking the time and generously sharing your resources and your insights with us today, and appreciate it very much. So thank you all.
Thanks, Bennett.
Thanks for having us.
So much.
Bye.